Wednesday, September 7th, 2022, Maneco 64, home of alternative economics and contrarian views. I have to say things are getting so crazy, not only economically, financially, but also politically, of course. Today, we're going to look at how they're trying to trick us. And by they, I mean the governments and the central banks. So what they're doing, it seems to me, is increasing fiscal spending or fiscal stimulus in a massive way and pretending that inflation is going to go down because of that. So they're basically printing more money in order to pivot. And it sounds crazy, doesn't it? But that's what we're going to look at today. Before I start, though, a little bit of history today, because many of you know that I was born in Brazil in 1964, hence Maneco 64. I grew up in Brazil. I went to university in the States, and then my family moved to Switzerland in the mid to late 80s. But the reason I'm talking about that today is that today is Brazilian Independence Day, September 7th, and it's actually the 200th anniversary, or the bicentennial, if you want to call it. So Brazil in 1822 became independent of Portugal. It was a strange independence, though. It was one of the sons of the Portuguese king stayed in Brazil and declared independence on September 7th, 1822. So it was like a family split there. And actually Brazil was a series of, a grouping of provinces. I'm not even sure that it wasn't really called Brazil. It was the Empire of Brazil. So Brazil is an empire from 1822 to 1889, so 77 years. It was basically run by, progeny of the Portuguese royal family. And in 1889, it became a republic. It was really a military coup in 1889, and it's been a republic ever since. The Brazilian royal family, they're still around, and I do follow them a little bit on Instagram. They're they're quite active. Will Brazil ever be an empire again, or a monarchy? I don't know. I would say not. But for those of you who read in Portuguese, there's a really good series of books, 3 books by the same author, Laurentino Gomes, that's his name. And I'll show you the first book in order of date, of course. The first book is 1808, Laurentino Gomes. This one is on Amazon. There's an English translation of this one, so you could read this. This talks about how Napoleon drove the Portuguese royal family to Brazil in 1808, and how the Royal Navy helped the Portuguese royal family go to Rio de Janeiro. And I guess if it hadn't been for Napoleon invading Portugal, Brazil probably wouldn't have become independent in 1822. So this is why this is quite important to read, I would say. And then there's another one by the same author, 1822, which talks about when the royal family split and Brazil became independent, so to speak. And then there's the other one, 1889, where it talks about the fall of the empire, so to speak, of the royal family of Brazil. So Brazil had Peter I, who was the first emperor. He wasn't there for that long, and he left for Portugal, and he left his son, who was under 18, as emperor, Peter II, and he was emperor until 1889. So Brazil had 2 emperors. And just a little bit about the money in Brazil. I've got a couple of 3 coins here, and they're all silver. Sterling silver was the standard of the Brazilian coins. And I guess the base of the system was 1,000 reais. And there's the 1,000 reais. And this was from 1863, this one. So very nice coin. It's a bit the size of a $50, I would say. And then you've got 2,000 reais. I've got one from 1888. You can see Peter II there, just before the collapse of his regime. There's the coat of arms. And just to show you that it stayed pretty steady, the currency. This is from 1888. And I've got a 2,000 reais, which is basically the same weight and content, silver content, 1853. So there you go. I remember my father, he still talked in terms of 1,000 reais, because the currencies in Brazil changed a lot, of course, in the 60s, 70s, 80s. It went from, we used to have cruzeiro, but one cruzeiro, my father would call it 1,000 reais, 1,000 reais. And that comes from that, of course, from the 1,000 reais. So that's just my history part for today. So we'll move over to present day, of course, the inflation situation. Yesterday, I spoke about the new UK Prime Minister, the new government, really. She's got new cabinet members, new chancellor. She's gotten rid of a lot of the old cabinet. And I said that they're looking to spend 100 billion, but it looks like it's going to be more, 170 billion. What are they going to do with that? Well, they're going to borrow that into existence, which means more and more debt. Some people think it's going to be even bigger than or similar to the fiscal spending we had in 2020 in response to COVID. And we know what happened. Ever since then, we've had massive price rises. Not inflation, we've had price rises. And that's my gripe here. And I've been saying this for years, that twisting the definition of inflation for it to mean the consequence of inflation, which is rising prices, is what's gonna really ruin our country and other countries, of course, and currencies, because even economists they've been brainwashed, or they've only been taught that inflation is actually a measure of price, and it isn't. We know that inflation is the creation of currency and credit and debt. Well, debt is the flip side of our currency, fiat currency, out of thin air by governments and central banks. And consequence of it, of course, is that you increase the supply of something, i.e. the currency. And if you don't increase the supply of goods and services in the economy, prices are going to rise, and they're going to keep rising. But there's this fallacy now, and I spoke about this in the beginning of the video, that they're trying to fool us. They're trying to pivot by increasing inflation. And you might think, what are you talking about? Well, we've got an economist here from Bloomberg who's saying now that the stimulus by the government, and we have to see how they're going to implement the stimulus. I don't know how they're going to cap the prices, but they're going to do some trick. But they're going to use borrowed money, 200 billion almost. I would say it's probably going to get to 200 billion. Right now it's 170. But as you can see here, a Bloomberg article yesterday, Liz Truss's energy bill rescue may mean UK inflation has peaked. Well, they've got it all wrong, the Bloomberg economists. Yes, CPI might peak temporarily, but inflation is getting even worse. And that's why I have very little hope for our currency. I have very little hope for the economy. And I think it's hyperinflation is more than ever a threat. It's increased even more. It's what the Germans did as well back in the 20s. They thought that creating more currency would help solve the cost of living crisis that they had, the inflationary crisis. And it's amazing we're making the same mistakes. So let's go through this article quickly here. Economists say freezing power and gas bill will cut inflation. No, it will cut the CPI and maybe the RPI, but it will mean more inflation. Stimulus now points to higher rates for longer, economists say. Of course it does. That they're right about. And higher rates will mean higher prices, which is what they mean to be inflation. Why higher prices with higher rates? Well, because our economy is based on credit, and if the cost of credit goes up, companies and consumers and the government, they're gonna have to raise prices or raise taxes in order to cover their financing costs. So this is by Philip Aldrich. It was from yesterday. Britain's inflation rate may already have passed its peak if Prime Minister Liz Truss moves ahead with her plans to freeze energy bills for households and businesses. My analogy for this is, let's say we had a very hot summer here in the UK this year, and temperatures got up to almost 100 degrees Fahrenheit, almost 40 degrees Celsius. So this is akin to someone lowering the thermometer, like fixing the thermometer, taking some of the mercury out to make it look like it's 20 degrees instead of 40 degrees, and say, it's not hot anymore, even though it's like hot as hell out there. And that's what they're doing. That's the analogy for this. Economists at Barclays, Berenberg, and Bloomberg Economics said Truss's package to rein in soaring electricity and natural gas prices would have a sweeping impact on the UK economy and may manage to arrest inflation at July's reading of 10.1%. Wow, it's going to make it even worse in the medium to long term. Why? Well, when you cap a price of anything, a commodity, a service, you create even more shortages, and eventually you won't be able to cap it anymore because you're trying to get people to pay less, but you won't have anything to buy. This is crazy, really. Let's continue, though. The forecasts underscore the importance of surging the cost of living squeeze to the outlook for the UK. By halting increases in utility bills, the governments could stop the biggest upward pressure on consumer prices, giving both consumers and investors breathing room to adjust to other pressures pushing up the cost of goods and services. Yeah, how are we going to adjust? Please tell me how we're going to adjust to that, especially when financing costs will be going up through the roof. Well, and here's a genius from Barclays, and he says inflation may already have peaked. Fabrice Montagne, UK economist at Barclays, wrote in a note to clients on Tuesday. I feel sorry for his clients. There is a case to expect higher inflation in other parts of the consumer basket as lower energy prices allow households to shift spending. It's not higher inflation, Mr. Montaigne, it's higher prices. We have a lot more inflation coming. It's coming. It's called the creation of currency and credit. It's really frustrating reading this. And here's the part of where I can see what's happening here. The UK government and the Bank of England are trying to pivot by creating money out of thin air, currency out of thin air, fiscal stimulus. So Ana Luis Andrade, or I guess the English would say Andrade, but it's actually a Portuguese name, Andrade, Ana Luis Andrade, of Bloomberg Economics, said the bill freeze would reduce the chances of a 75 basis point hike in September. But by raising the risk of the economy overheating, the flip side could be higher rates for longer. So I would have expected the Bank of England, after this fiscal stimulus announcement, to actually raise rates even more, because they should know that this is inflationary, creating more debt and currency out of thin air. But this is just an economist from Bloomberg. Bank of England is not going to listen to them. Are they? Well, I've looked up Ana Luisa Andrade, and guess where she was an economist at for a year and 2 months? Bank of England. So she's worked for the Bank of England. She coordinated the MPC's global economy forecast in different policy rounds, developed key forecasts and scenario analysis, assessed potential impact of global financial stability risk, contributed to thematic analysis for policy notes. Well, she didn't do a very good job forecasting rising prices, did she? And now she's at Bloomberg telling the world that this increase in inflation will be good to bring down inflation. Let's see what her thinking is, because it says here what Bloomberg Economics says, and she is Bloomberg Economics according to the Bloomberg article. Incoming UK Prime Minister Liz Truss is reported to be considering an energy cap freeze for households, as well as fresh support for business. It's early days, but if her plans materialize, the emergency relief would be similar in scale to government support during the pandemic. That would drastically change the economy's outlook. In this scenario, inflation won't rise much further from the current levels, and the Bank of England's 2% target would be in sight within a year. A recession is also likely to be avoided. Wow, that's great, isn't it? That's because the Bank of England's target after the pandemic stimulus went down to 2%, right? Miss Andrade from Bloomberg Economics. My goodness, batten down the hatches. It's going to get a lot worse. And they're trying to trick you and trick investors. So, with that frustrating rant, let's move on to the markets this morning. So it's 8:20 a.m. London time. We've got spot or paper gold on the LBMA and Crimex markets, trading down about $3, just below 1,700. High's been 1,704. The low is 1,691. Silver is up a cent, just above 1802. The high has been 1810. The low is 1783. By now, I expect many people to be very frustrated, of course, with precious metals. But it's not the precious metals that is frustrating. It's more the manipulation. And unfortunately, many people's savings will be wiped out. That is fiat currency savings. Yesterday, for example, I went to my local coin dealer, as people call it in the States, LCD. We don't call it LCD here, but and I bought a bit of silver, some silver 1 ounce silver eagles, but I also bought some really nice numismatic coins. So yeah, I mean anything but fiat currency. And this philosophy here that we're seeing trying to be pushed into investors and the public is very dangerous. It's going to make things even worse. So, to the stock market, Dow future is down 81, 0.25%. NASDAQ 100 future is down about 0.2, just below 12,000. And the S&P is down about 10 points at 3,900. FTSE is down 80 points or 1% at 7216. Eurostoxx 50 is down just under 1%. To the currencies, sterling is tested again, that March 2020 low, the low Today was 114.50. Right now it's down 0.25% at 114.93. The euro is unchanged at 99. The dollar, I mean, the yen is a joke. The yen is collapsing, really. It's at 144 the dollar now. I mean, and it's dollar is up 1%. I feel sorry for the Japanese consumer, the Japanese public, but that's the way it is. The dollar is up slightly versus the Swiss franc, 98.50. And the dollar is up 0.2% versus the yuan at 698.38. So let's check the dollar ruble exchange rate. Well, the dollar is up a little bit here at 61.50. It's crept up a little bit. To the other currencies, Aussie dollar is down a third at 67.12. Dollar is up a third versus the Canadian dollar at 131.92. And the Kiwi dollar is down 0.5% at 60.10. To the general commodities, WTI crude is down 1.5% at 85.60. Brent crude is down 1.3 at 91.50. High-grade copper is down 1.25% at 341, and U.S. nat gas is down 1.5% at 804. The Dutch nat gas future, TTF future, yeah, that's down another 1.2% at 237. Yes, it has come off quite a bit. I still expect a lot of volatility in this European nat gas futures. Just to give you an idea, pre-2020, this traded between 10 and 15, and we're at 236. So just, it's crazy. We'll finish off with the bond market. The 2-year gilt yield is down 2.5 basis points at 316. So this twisted thinking that says that the Bank of England now doesn't have to raise rates as much because the government has created 200 billion out of thin air and to cap energy prices. So that means there's no inflation. I mean, this is why the 2-year yield has come off, because yesterday I think it went up to almost 330. So I think the Bank of England, they meet on the 15th of September. Personally, I think they should raise rates by even more, like by 1%. We'll have to see what they do, though. The 10-year yield is up almost 2 basis points at 311. So now to the U.S. Treasury curve. The 2-year yield is down about 1.5 basis points, just below 350 at 349. And the 10-year yield is unchanged at 334. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. And also think about subscribing to my channel if you haven't yet. And with that, I wish you all a great rest of the day. Take care. Bye.